market's worth billions of dollars, and obviously the overall direction of it. The good thing about the Eurodollar market is it has a consistency. The direction is generally moving in one direction, and it stays moving in one direction pretty much every day. There is a level, however, that comes into your considerations each day, and in the olden days it had a lot more importance, but it's still got a lot of importance today, and it's called the LIBOR fixing process. And there's some very close personal colleagues of mine who have known all about the LIBOR fixing process. You might have seen a few of them on the news, but there's obviously been a bit of a problem with the LIBOR fixing process, because obviously all the bank traders, who all believe, to be perfectly honest, and I know this from first-hand experience, all the bank traders believe they weren't doing anything wrong during that process. They obviously are fixing a rate. They obviously know what they're going to be doing during the fixing of that rate. They know where the orders are during the fixing of that rate, and they're trying to make a buck based on that idea. They're trying to make a buck based on this idea. So what's the Eurodollar futures? Well, the Eurodollar futures is based upon the LIBOR rate. So the one thing that you'll probably be aware of is that the LIBOR rate itself gets fixed every morning in London at 11:55 approximately. It's not on the tick. It's not on the tick, but 11:55 the LIBOR rate gets fixed each day. So all you have to do in terms of this chart is just simply draw a little box from the fix, and then look at the price action that happens next. Look at the price action that happens next. Look at the price action that happens next. Watch the price action that happens next. Watch the price action that happens next. This arrow should actually be along here a little bit, because we've got a break here first. Watch the price action that happens. Watch the price action that happens, and then watch the price action that happens. So when you look at this trade, you might be saying, okay, well, I'm never going to trade Eurodollars, Ray, but thanks for the information. It's as much use as an inflatable ashtray. That's different from a chocolate ashtray, guys. We thought we'd do an inflatable ashtray for a change. So it's as much use as an inflatable ashtray. And what can you use it for? What can you use it for? Well, obviously, as this market is trading up, this is the direction of short-term interest rates, isn't it? It's the direction of short-term interest rates. So if it's the direction of short-term interest rates, it's also the direction of, well, it's obviously the opposite direction from short-term interest rates, but you get the basic idea. You can do 100 minus this one, or you can just do this one. The other thing, obviously, you can look at it is, well, if that's the movement of short-term interest rates, it's also going to be the movement of ZT, 2-year treasuries. It's also going to be the movement of ZB, 30-year treasuries, in most cases. This is the macro movement, because all treasuries go up roughly about the same time by differing degrees. Sometimes the back end goes up faster and harder than the front end, and sometimes the front end goes up harder and faster than the back end. And obviously, depending upon which one's moving the most, we get flatteners and steepeners in the curve, and we'll obviously spend a lot of time on this when we move into the bond section at the end of this course, so that people can avoid it if they want to, but I would recommend you don't. Anyway, so when we see this, the good thing, as we said before, is that this isn't going to be the type of chart that goes buy side, sell side. And this is the type of chart that's going to go buy side and stay buy side for the day off the LIBOR fix. It's going to go buy side and stay buy side for the day off the LIBOR fix, and go sell side for the LIBOR fix, and then go buy side for the LIBOR fix, and then go buy side for the LIBOR fix, and then go buy side, surprisingly enough, for the LIBOR fix, and then today going buy side for the LIBOR fix again here, look. So if this is the direction of short-term securities about fixed incomes, then obviously the high probability is that the ZT will do exactly the same. And the high probability is that the ZB will do exactly the same. So let's take a look at ZT. This is the 2-year treasuries. And tell me if it's not exactly the same. Well, the answer is pretty much yes, it is. So if I replaced the Eurodollar market with these arrows, And these were buying opportunities, for example, on the U.S. Treasuries, or selling opportunities in U.S. Treasuries. Take a look. There's a nice buy trade right there. U.S. Treasuries go up. You can see this arrow here. U.S. Treasuries go down. You can see this arrow here, or this arrow here. Wherever it goes back bid here, you can see this bottom edges, forums on the Treasuries, and the Treasury goes up. You can see this buy arrow. The Treasury continues to go up. This buy arrow, the Treasuries pull back and then continues to go up. This buy arrow, the Treasuries pull back, and obviously we've started to buy the bottom edge Treasury. As you know, we bought the Treasuries today, as you know. And obviously we've been buying into that bottom edge. We gave you a price this morning, did we not? Did I not give you a price this morning of where to buy Treasuries, guys? Yes or no? What do you think? Did I give you a price this morning to buy Treasuries at, Miguel? I know you buy Treasuries. Who heard me? Who heard me? What price was our Treasuries today? What price were we wanting for Treasuries today? 2s and 3s. Thank you very much. What's happened since that call, guys? What's happened since that call? 2s and 3s. What's happened since that call is that we got the first trade. Remember, we took it off into this change of behavior level here. And then we got another opportunity to buy 2s and 3s. It's traded back up to 9s again. Now, you might be laughing at it saying, holy fecking moly, Reef. You know, you're talking about a 7-tick trade here. You're talking about an 8-tick trade. Well, put 2 8s together and you've got half a point. Half a point is a $500 day on a single on Treasury bonds on 2 trades. Correct? Is that not exactly the right price that we gave you this morning at 2s and 3s? Yes, it is. Did it then retest that 2s and 3s? Yes, it did. Is it not the perfect trade? Yes, it is. Accurate to 1 tick, isn't it? Accurate to 1 tick. So obviously it pays, I mean, because this trade made us $500 per contract, guys. And this isn't a small trade for us. Bonds are one of our biggest trades, in fact. It accounts for fixed income in our section, accounts for a very, very, very substantial percentage of all the trades that we do. So this is an enormous trade in terms of value for us, but it's all very, very simply based around some of these ideas. And this is the simplest part of the idea. Obviously, the next part of the idea is the shape of the curve, the logic behind the curve. When we deconstruct the curve into its various segments, the 2s to the 5s, the 5s to the 10s, the 10s to the 30s, the 30s to the ultras. When we deconstruct the curve and we look at the relationship of the front to the belly to the end, and we start to understand why the curve changes shape, under what kind of stimulus does the curve change shape. When we start understanding the twist in the curve, you're going to start finding some very, very high probability bond trades. Anyway, so just recognizing, the first thing is recognizing the movement of the LIBOR fix, guys. If the LIBOR fix is up, Treasuries as a rule should be trying to find bottom edges, especially into the US cash open, which is going to be, say, 1:30 in the US session and then 2:30 for the cash open in the equities. You're going to be looking at that sort of 1:30 kind of price area. You're going to be looking at 2:30 price area. And obviously that's the levels that you're going to know about after the 12 o'clock fix in terms of the LIBOR. So these are the first 2 price areas that you're going to start focused on. And obviously when you start seeing the big volume down bars coming into this level, here's a great example today, in fact. Now remember, at 11:55 you now know this information, okay? So we know this information here, don't we? We know this information for this big up move here. So this becomes like the dividing line, doesn't it? So if LIBOR stays bid at that stage, any break below this is going to be finding a lot of institutional buyers. So there's obviously going to be an institutional buyer there. You can see the big spike in volume. The price goes up from that. There's obviously a big institutional buyer coming in here. This is still a little bit cheap for me. I mean, I told you where I was dealing, 2s and 3s. And then obviously we started to step into this area here. And obviously that takeaway was rather sexy. No new sellers coming in. Bottom edge. Profit take, and obviously we're now long the market. We've taken some profits and now we're long the market for this rest of this session. We're obviously going to try and hold on to these longs as long as possible perhaps through the Asian session right into tomorrow's fix. So we'll have to make a decision on that one as we come into the US close to see what we're going to do. So it's not just about understanding the ZT. It's not about just understanding the ZT, because obviously when we look at this movement, we can obviously look at this movement in relation to the likes of the bond itself, the ZB contract, for example, or the ZN. And obviously you'll see again from these arrows, you'll see the opportunity to be long into this market or short into this market. Take a look at this little phase here coming into the back end of July. Look at the LIBOR fix against the levels, constantly trading down one tick, down one tick, down two ticks. What the heck is the price doing up here? Well, what it's doing up there is giving us an opportunity to get heavy short bonds, isn't it? That's what it's doing. So when you see that very, very top edge print up here, you're looking at that very, very big opportunity to smack into some ZBs massively and take the price sell side. And that's exactly what happened. The price dropped by thousands of dollars. That drop there was worth thousands of dollars per contract. And it's so visible, so very easily visible to anybody that knows this stuff. So very easy to see this opportunity, isn't it? And then obviously these pullbacks here, brilliant opportunity to accumulate longs. There's the first, there's the second, there's the 3 times a lady into the bottom edge on this occasion. And at that stage, we've actually gone above on the LIBOR fix. And obviously at that stage, it's just a case of how much bonds can I get? How many bonds can I buy into that bottom edge? As much as I can possibly get my grubby mitts on. And you can see that that move was worth thousands of dollars per contract. Thousands of dollars per contract. And obviously this move here, you can see it's almost as good as this one. Into a bottom edge, this is a very, very good trade opportunity. And that's the 2s and 3s that we've just talked about. That's why we took the 2s and the 3s. That's why we had supreme confidence about getting that 2s and 3s onto the book. And obviously we are the ones that have made... We're the ones that have made 8 ticks to 16 ticks profit on that trade already, $500 per contract. That's not bad when you've maybe got 1,000 lots off the bottom edge. It's not bad when you've got a 1 lot off the bottom edge, guys. Seriously, $500 on a single contract on 2 trades at identical prices. You'll take that any day of the week. Absolutely, why the hell not? Beautiful. And that's all you're doing, guys. Some of the simple stuff. Just get the idea of where the LIBOR fix is, mark it on the charts, see what direction the price action moves on the fix itself, because it very rarely reverses. It has done it, but it very rarely reverses itself. And then obviously once we get into the logic of the fix itself, when we start looking at the logic of whether it should fix higher or lower, you're going to start predicting whether the fix is going to go up or down. Well, if you can start predicting if the fix is going up and down, and we've already established whether the bonds move in positive or negative correlation to this, then obviously by being able to predict the fix, you'll be able to start predicting the bonds, won't you? Because if the bond goes in the direction of the fix and you can predict the direction of the fix, you're going to be able to start being able to put forecasts into your bond market that you can start buying into or selling into these very, very simple little profitable opportunities. So one of the opportunities can make you a fortune. Any one of these could be a very, very, very big trade for you. You don't know in the bond market. Sometimes it can be 6 tick rotation. Sometimes it can be 5 ticks. Sometimes it can be 30 ticks. Sometimes it can be a full point. Sometimes it can be 2 points. It is a very, very consistent market. Now, for bond traders, we've always said very, very simply in the past, it's not for everybody. It is for the guys that like a lot of, slightly more math into their trading. It is useful for the guys that are slightly more, slightly better capitalized. And the reason for that is that you can go into spread trading. You can trade the flattening and steepening of spreads. You can get some good size into these trades, very good size into these trades. And obviously as you start to develop that type of knowledge, that's going to start helping you with your other trades. You're going to start seeing flatteners and steepeners, especially at the front end, becoming very, very, very clearly defining things like top edge equities and bottom edge equities. And obviously when we come into the economic life cycle, when we start looking at the life cycle of the economy, you're going to start seeing this process of markets moving from a steeper economy into a flatter economy, and that is going to be able to be visible on your bond yield charts and your bond spread charts. And that's the euro dollar, guys. So I'm going to finish off at that. We're going to keep these sessions at just nice, short and sharp, because obviously there's going to be some times that we're going to be wanting to still cover some stuff that we've seen during the day. And therefore, these are going to be nice and short and sharp. We're just going to be looking at maybe one or two different things that happened each day, or one or two things that we talked about each day. And then obviously the classroom, where we're not going to be talking about today, we're going to be talking about the classroom elements, is going to be from 8 o'clock London time, as far as I'm aware anyway, unless I've screwed up somewhere. But 8 o'clock London time, which is going to be 3 o'clock Eastern. And that's the ones that are also going to be recorded, and that's the actual main classroom that we're going to get into tonight. So I'm going to finish off at that, guys. How did I know? Well, the reason why, Reeve, is a kind of stupid reason, but that's the price we were going to start buying at. You know, it sounds stupid, but that's the price I'm already starting to buy at. I didn't know it was going to go 2s and 3s, but if it hit 2s and 3s, we were going to start launching substantial buying into bond market. Okay, so you know, if I'm telling you that we're buying the bonds at that price, we're one of the biggest bond traders in the world here. If I say it's going to be 2s and 3s, I can pretty much guarantee it's not going to go much further than 2s and 3s. Okay. Anyway, the US dollar, well, the interesting thing is, what do you think the dollar yen would look like against this line here? What do you think, John, the dollar yen would look like against this line? Or in fact, let me change it around for anybody. Let me just change it around, John. If I said the Japanese yen US dollar, what do you think the Japanese yen US dollar would look like against this chart? Positive or negative core? Positive correlation. Do you think Japanese yen US dollar is a positive correlation to the euro dollar futures markets? Let's take a look. Let's take a look. Japanese yen against the US dollar. Remember, it's not dollar yen, it's yen dollar. What do you think, guys? It's almost exactly the same, isn't it? It's almost exactly the same. You see it? Japanese yen, hold on a second. So you can see quite clearly that the Japanese yen and the euro dollar market are almost exactly the same instrument, aren't they? We're not talking about the euro dollar currency, of course. We're not talking about, this isn't the euro dollar. A lot of people think the euro dollar is the euro dollar currency markets. It's nothing to do with the euro dollar currency markets. This is the euro dollar interest rate market, okay? The euro dollar interest rate market, okay? So obviously, when we look at the Japanese yen against the euro dollar interest rate market, it obviously is positively correlated. In other words, it's negatively correlated to yield. And that's what we said actually earlier, isn't it? When you asked the question about the yield, and you says, what drives the US dollar? Obviously, I was thinking you were talking about the US dollar itself when you asked the question. And my answer to you was yield. So if this is the interest rate market here, this should have a very, very strong positive correlation to the movement of Japanese yen against US dollar, isn't it? So yeah, it's the correlation can sometimes break down, but not very often. Not very often. If I zoom out a little bit here, you'll see that this relationship is incredibly powerful. Incredibly powerful. And you can see the movement of the Japanese yen against the dollar. Now you might be saying, okay, well that's interesting. What about something like Japanese yen against the pound? And this is when you start seeing some of these connectedness elements of the marketplace. So we're looking at Japanese yen pound, and obviously we've just seen it against the dollar. Now obviously I'll just rescale this very, very quickly for you. And you'll see that the Japanese yen against the pound also has that exactly the same positive correlation, as you would expect, as you would have anticipated, isn't it? But isn't that a really good, strong piece of information to go short pound yen? Is that not a very strong piece of information to just be short the pound against the yen here? From the 2nd of August, mind. From the 2nd of August, guys. It's not a short-term swing here. Do you know what I mean? It's not a short-term swing here. It's not something that you're going to be looking at saying, yeah, well, it's good for the 5-minute chart. It's good for 20 pips here. It's good for 20 pips there. We're going back for several days here, boys. Several days. From the 2nd of August is when that short trade started to appear. Well, I don't know if you realize this, guys, but when you recognize that on that chart, and you start to see these types of elements, and this is obviously where John was leading to, is what kind of opportunities can a chart like this present to you? Take a look at that short trade on the pound yen. The price was 147 on the 2nd of August. It's 147s, 146.5. So that's where the price is when we're knowing that it's going to go short. It traded 140. Now I know that it's only 700 pips, but is that not a very, very easy 700 pips off of these key wholesale price levels? It's not a very easy 700 pips. Yeah, it's only 700 pips at the end of the day. I know most of you can do better than that on day trading on a scalp basis, but when you get it right, guys, this is exactly what you're trying to see. This is not the kind of market here. This is not the kind of market here that chops and changes. This is the reason why this chart is so exciting. And believe me, anytime I say the euro-dollar chart looks exciting, and I'm talking about the euro-dollar interest rate chart looks exciting, they say you're off your fecking trolley. This chart's worth huge amounts of money if you just watch it. And you don't have to watch it that much, guys. It doesn't go anywhere very fast. You know what I mean? It's like watching a turtle moving along the pavement. You can look back in a couple of hours' time and it'll just be getting to the edge. You know what I mean? It's never going to be giving you any massive opportunities, but yet it gave you 700 pips of information. It gave you 700 pips of information. And when we see this 700 pips of information here, and you start seeing this market pop, you go, okay, well, I know what I'm going to be doing. I know where I'm going to be doing it. I know how I'm going to be doing it. Let's get some business done. Now, you can see there was one reversal, and the reversal was on the 6th. You can see there was one reversal on the 6th, and it reversed back into another market. And you can see as we come into the 6th, we're coming down into this green line here at 144. We get this little bounce for 50 pips. And then obviously we're back short, and then we get the next big break, another big break, and then another key big break to the downside. Now obviously there's other elements that go towards this chart here. There's obviously spreads. You can see this is the 10-10 spread. You can see again that this is a very, very strong relationship overall. But that's better to be seen on the daily chart, because obviously when the Japanese bond is open, the London bond is closed, the gilts are closed when the GGB bonds are open, okay? And obviously we can look at the pension funds when it comes to that chart as well. We can look at the overall shape of the pension funds. UK FTSE against the Nikkei index to make sure that we've got the right trade in terms of the pension fund movement of price. So yeah, absolutely, John. It's one of those types of charts that most people will completely dismiss. And as a macro chart, it's incredibly valuable. And it's, 99.99% of retail traders just would never look at this chart. And yet, if I said to you, follow this chart and you're going to make 700 pips on the pound against the yen, you'd have been like, I'm going to pay attention to that, Ray. Thank you very much. I'll take some of that money. I'll take some of that money. Okay, guys. As I said, I'm going to pack up at that. We've got classroom. Now, this is the part of the classroom, guys, that we're going to talk about stuff. And there isn't a fixed agenda for these things. It's about stuff that's happening live in the marketplace. It's about elements that have come up by questions that you guys have got during the course of the day that maybe I haven't either answered, or perhaps you've preferred to get it recorded so that when I do answer it, you can go back over it and say, okay, I now get it. I kind of figure that out. So that's what these types of sessions are there for, guys. If there's nothing you know, if there's something you're struggling with, or something, a point you're trying to make, and you've maybe felt that I haven't answered. Is it in their shadow, as some people like to call it? You don't want to trade in the shadow, guys. You want to be part of the trade. You want to be deviate off of the subject, because we're going to record it so that when I do answer it, you can go back over it and say, okay, I now get it. I kind of figure that out. So that's what these types of sessions are there for, guys. If there's nothing you know, if there's something you're struggling with, or something, a point you're trying to make, and you've maybe felt that I haven't answered it properly, just come back in and give us another shot at it, and we'll come back to the charts and we'll start looking at it, and we'll try and get to the bottom of the question that you've got. This is the time of the day to do it, because obviously I'm finished my desk at 4 o'clock anyway. So as far as I'm concerned, this is now kind of a little bit of free time for me. And obviously, you know, the classroom sessions are going to be specific to the subject, and we're going to try and not deviate. There's always going to be, you know, we're always going to deviate off of the subject, because we're going to kind of, you know, we're going to kind of bring in some of the other subjects from other elements, like profile, for example. We'll bring in maybe some profile elements when we're talking about the order flow. We'll maybe bring in a couple of examples of value when we're looking at some of these order flow things as well. So we'll kind of dovetail into some of these types of sessions, some of the other information that we're going to be adding. But it's all part of the same jigsaw, guys. If you think about a jigsaw puzzle, by the end of this course, the objective of this course is that by the end of this course, you should be able to make the jigsaw puzzle. And what is the jigsaw puzzle? Well, the jigsaw puzzle is, what is an institutional buyer or seller doing, and where are they doing it, and when are they doing it? That's when you finish the jigsaw, you should know what they're doing. And because you should know what they're doing, you should be in great position to do the same, not trading in their shadow, as some people like to call it. You don't want to trade in the shadow, guys. You want to be part of the trade. You want to be involved in the same trade that Goldman's doing, not after Goldman's are long, then looking at the trade and saying, well, I now want to be long. I know I'm 50 pips higher than they are, but I still want to be long. Wrong. You want to be in the process that they're getting long into. And you want to be in the same reason why they're getting long into those processes. And therefore, you can take advantage of the same trades that Goldman's are doing, the same trades that JP's are doing, the same trades that Nomura is doing. You want to take advantage of those types of opportunities as they develop, not after they've already developed, okay? You're not a hindsight trader. You're a right-hand edge, and you're an aggressive institutional player from now on, guys. Just get it clear. That's what you now are, is an aggressive institutional dealer, and you've got to be willing to step up and take those types of aggressive trades. You've got to be having the confidence to do it. And obviously by the end of this course, the jigsaw puzzle should be complete. But obviously it starts by learning to put in the squares, the corners, and then it starts building into the whole picture. That's what we're going to be looking for. Anyway, I am going to take a break at that, guys. I'll be back for 8 o'clock. And the 8 o'clock class will probably be about 2 hours as well. We'll probably try and keep it to 2 hours. I know that I've got a tendency to go a little bit above 2 hours, and a lot of people just lose attention, basically, listening to my droning voice all day. So we'll try and keep it sharp. We'll try and keep it to 2 hours. We'll try and get, you know, squeeze it all in without missing anything out, and we'll just rattle it. In the meantime, I'll see you guys later.